Hello everyone and welcome. In this session, we're going to tackle a really foundational concept in Canadian corporate tax planning.
So, what are we talking about? We are going to be demystifying the Section 85 rollover, and trust me, this is one of the most powerful, really powerful, tools in the toolbox when you're moving assets into a corporation. Getting a handle on this is absolutely key. Okay, let's just jump right in with a very real-world problem. Picture this. You've been running your business, and you have an asset that's shot up in value. You paid $500,000 for it, now it's worth $700,000. That's fantastic, but now you want to incorporate. If you just move that asset over, bam, you could be looking at a massive, immediate tax bill. So, what do? How do you avoid that?
Well, the answer lies in a very special provision in our Income Tax Act. It's called a Section 85 rollover. Think of it like a special agreement. It lets you and your new corporation choose a magic number, a transfer price. This is the game changer right here, because it gives you control over how much gain gets taxed today and lets you push the rest of that tax bill way down the road.
All right, so here's how we're going to break this down today. We'll start with the problem, then get into the nitty-gritty of setting the price, see what it means for the person transferring the asset, figure out the value of the shares they get back, look at the impact on the corporation, and then, tie it all together with the big takeaways.
Okay, let's get to it. We're going to walk through this with a case study. Let's meet Lucy and her brand new company, MJ Corp.
So here's the situation for Lucy. She's got this depreciable asset, right? She bought it for $500,000, but its fair market value today is a cool $700,000. You can see the problem right away. That's a $200,000 gain just sitting there. Her big goal is to get this asset into MJ Corp, but she really wants to avoid paying tax on that full $200,000 right now.
All right, so how does Section 85 actually fix this? Well, it's all about choosing, or electing, a transfer price. But you can't just pick any number out of thin air. No, there are rules. The Tax Act gives you a very specific range you have to play within.
Let's start with the easy part, the ceiling. The highest price you can possibly elect is pretty simple. It's just the fair market value of the asset. So for Lucy, that's $700,000. Can't go a penny higher.
Now the floor, the lowest price you can elect, that's where things get a little more interesting. It's not just one number. For an asset like this, one that depreciates, the floor is the greater of two different amounts. The first is what we call non-share consideration. You'll often hear it called boot. And the second is the asset's tax cost, what we call its undepreciated capital cost, or UCC.
Okay, so let's actually calculate this floor for Lucy. First, we have the boot. In this case, it's a promissory note that MJ Corp is giving to Lucy, and it's for $300,000. Got it. Next, we have the asset's tax cost, its UCC, which is $380,000. The rule is simple. You have to pick the greater of those two. So $300,000 versus $380,000, our floor is $380,000. Easy as that.
So there you have it. This is Lucy's playground, her strategic window. She and her company can jointly elect any transfer price they want, as long as it's between that floor of $380,000 and that ceiling of $700,000. Any number in that range is perfectly legal and valid.
Now, this is where it gets really clever. Lucy could elect the lowest possible price to defer the maximum tax, right? But she doesn't. Why? Because she has an old capital loss sitting around that she wants to use up. And to do that, she needs to trigger a capital gain. Specifically, she wants to trigger exactly $90,000 of gain. So she does the math. Her original cost was $500,000, add the $90,000 gain she wants, and voila! She elects a transfer price of $590,000. It's a precise strategic move.
Okay, so Lucy's made her choice, $590,000. What does that actually mean for her when she files her taxes? Let's break down the consequences for her personally.
First up, the capital gain. It's pretty straightforward. Her proceeds of disposition are that elected price, $590,000. We subtract her adjusted cost base, what she paid for it, of $500,000. And there it is, the $90,000 capital gain she was aiming for. Now, you know the inclusion rate in Canada is 50%, so that gives her a taxable capital gain of $45,000. This gets completely offset by that loss she had. Mission accomplished. Perfect.
And this chart really just drives the point home, doesn't it? The total gain was $200,000, but she's only dealing with $90,000 of it today. The other $110,000, that's been deferred. It didn't disappear, mind you. That tax is just postponed. It's kicked down the road for another day.
But wait, there's more. The capital gain isn't the only thing Lucy has to think about. Remember, this is a depreciable asset, and that means we have to talk about something called recapture. What is it? Well, it happens when you sell an asset for more than its tax value, its UCC. It's basically the tax system's way of saying, hey, wait a minute, you claimed all this depreciation over the years, which lowered your taxes, but now you sold it for more than we thought it was worth, so you're going to have to pay some of that back. It gets added right back into your income.
So how does the math work? Let's trace it. We start with the UCC of the asset class, $380,000. Then, the rule says we have to deduct the lesser of two numbers, her original cost, $500,000, or her proceeds, $590,000. The lesser of those two is obviously the $500,000. So 380 minus 500. That leaves us with a negative balance of $120,000. And whenever you have a negative balance like that, the entire amount becomes recapture. And here's the kicker. This is not a capital gain. This is taxed as regular old business income, which means it gets hit at her highest personal tax rate.
All right, let's switch gears a little. In exchange for this asset, Lucy got two things back, that note and some shares in MJ Corp. So now we need to figure out what's the tax value of those new shares.
Okay, so there's a formula for this, and it's actually pretty logical. To find the cost base of her shares, we start with the elected price she chose, $590,000. Then we just subtract the value of anything she got that wasn't a share, the boot. In this case, that's the $300,000 note. 590 minus 300 leaves us with an adjusted cost base, or ACB, of $290,000. And that number, that ACB, is super important because it's what she'll use to figure out her capital gain way in the future when she decides to sell these shares.
Now, this is a really important point. Her shares effectively have two different tax values that we need to keep straight. We just figured out the ACB, right? That's her cost for capital gains purposes if she sells them. But then there's this other concept called paid-up capital, or PUC. You can think of PUC as the amount of money the corporation can give back to her totally tax-free, like a return of her original investment. It's not a dividend. And a key takeaway from a Section 85 is that after the dust settles, the ACB and the PUC are hardly ever the same number.
Okay, we've looked at Lucy. Now let's flip the coin. What does this all look like from the corporation's point of view? What does MJ Corp put on its books as the cost of this new asset?
This is one of those concepts that can feel a bit strange at first. MJ Corp now has two different cost amounts for the exact same asset. It's weird, but it's true. If MJ Corp turns around and sells this asset someday, its cost for calculating that capital gain is easy. It's just the elected price of $590,000. But for claiming depreciation for CCA every year, the cost is something else entirely. For that, we take Lucy's original cost of $500,000 and we add half of the gain she recognized. So that $45,000. That gives a corporation a depreciation base of $545,000. Two different numbers for two different purposes.
All right, let's zoom out and put it all together. What's the final score? Lucy moved her asset, she deferred a big chunk of capital gain, but she also cleverly triggered just enough gain to use up a loss. She did have to pay tax on some recapture income, though. And the corporation? It now owns the asset, but it has to track that tricky split cost base for its own future taxes. So, what's the big picture here? This case really shows us that tax rules are so much more than just filling out forms. They're powerful, strategic levers. I mean, the Section 85 rollover gives you, the taxpayer, an incredible amount of control over when you pay your tax. And that just opens up a bigger question, doesn't it? If this one tool can do all this, what other planning opportunities are sitting out there, just waiting to be used to shape the entire financial future of a business?